Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And it is my great pleasure today to have another amazing guest on the podcast, Mr. Justin Huhn from the Uranium Insider. Justin is known in capital markets and the finance space as being the certainly one of the foremost experts in uranium. He's going to tell us all about his fund and his Uranium Insider newsletter, which is a fantastic subscription service. We're going to talk about macro commentary and shedding light on the rather obscure market that is the uranium market. And of course, we're going to tie it up with the ROI segment where Justin tells us about some of his big wins. And without further ado, it is my pleasure to welcome you to the channel. Justin, how are you doing, sir?
I'm doing very well. Yeah, thank you for having me, Ben. Appreciate it.
No, my pleasure. Absolutely. Can I get you, please, just to give a brief introduction to yourself in terms of how you got started into the investment space and what led you specifically into having this specific niche interest in uranium?
Sure. What really first got me interested in investing, which was a little bit more than a decade ago, honestly, was kind of the excitement around being able to have a return on savings. So, regardless of how much money I had made on a year-over-year basis prior to that, I had always struggled with saving, and there was something about learning how to trade and how to invest, and learning about the markets, and increasing, putting some leverage onto just sitting on cash that made that process of savings sort of exciting for me. And that's been one of the greatest experiences of my life so far. I really like, and I still do this, but this is the way that I started out. What I even recommend, especially to beginning investors, is set up a trading account, set up automatic deposits. Doesn't matter how much it is, in an amount that you won't even notice is gone from your account, right? So because I've learned this lesson over and over, I get really excited about it. Some thesis, I get very aggressive with deposits into my trading account. Whether or not I do well with that, if something in life requires me to pull money out of that account, it's never at the right time. It's never at the right time,
You
which
just
is,
described
the
my
right.
life.
Yeah. So if you can make consistent deposits into an investing or trading account in a recurring amount that you won't even notice is gone. So that could be a cup of coffee a week or something like that. I mean, just to get started, that will accumulate, and you can have a growing amount of money in an account that for yourself is relevant and helpful towards investing in retirement savings goals. That's really what got me excited, was this whole world where I can gain leverage on just sitting on cash, because just sitting on cash never really did it for me. In my 20s, I should say. And so
How old
that's
were
what
you
got
when
me.
you first started really exercising this idea of an automated savings program or storage program? So your income comes in and you put aside part of it for the purposes of investing. Do you remember what age you were?
I was pretty late to the game, so I would say I was early 30s when I started that. It was kind of about the same time that I got into investing and trading. Yeah, yeah. And prior to that, I was, and before I got into investing and trading, I was actually farming. I had a small organic farm with a couple of friends. It became certified organic. We did a community supported agriculture program. We started a seed company. We're breeding plants and saving seeds, and really focused on kind of ideologically driven sustainability exercises and practices. So we started out growing food by hand, had no
Wow.
mechanization whatsoever. So we were out there with a big broad fork and digging forks and shovels and planting by hand and watering by hand. And it was a lot of work. I was in great shape at the time. Learned a lot about sustainability, and I still have a lot of that same passion. But that sort of led into my experience with trading and investing.
Okay, interesting. And so you got started in trading and investing. And what were your early experiences like? Did you have a few quick wins and then you got hooked? Or was it the case where you had to work a little bit harder in terms of finding a formula that worked for you to gain investment success?
I pretty early on, I was really lucky to meet somebody actually through the Seeking Alpha platform who was a masterful technical trader. And he basically brought me under his wing and taught me so much about technical trading. And I loved his style, and I still implement his style in some technical trades that I still undertake. So the majority of my portfolio is fundamental investments at this point, and I don't ignore charts, but I don't trade solely off of charts for very much, with an exception of I have a small account for swing trading just to keep my monkey mind busy. But this person had very, very strict rules with trading. And so I got to learn that sort of discipline. You're looking at a chart, you don't want to know anything about the company or the sector or anything. You're looking at patterns, you're looking at volume, you're looking at breakouts. The chart pattern would actually dictate to you based on where you would get stopped out, and that would tell you your position sizing and strict rules, and you follow them no matter what. No matter if you think it's going to reverse the next day, you get stopped out on a daily close, you're out the next morning, period. So that taught me a lot about discipline in the markets and trading with as little emotion as possible. And at some point in that process, I started to kind of pay more attention to fundamentals. So if I understood the reason why a chart broke out, that would add to my conviction to hold through volatility that followed that breakout, right? So if I understood this company absolutely killed earnings and it gaps up, well, a lot of times it'll fill that gap. And if that stops you out, that doesn't do any good if you understand the fundamentals for that company and where the company is going in terms of future earnings, whatever it might be. So I started to kind of blend fundamentals and technicals a little bit, and found that it was positively influencing my ROI on these technical trades. And I did that for a number of years with pretty decent returns. And in 2016 is when the uranium thesis came to me. That was through a podcast, through Frank Curzio's Wall Street Unplugged. He interviewed Jordan Trimble from Sky Harbor Resources, and that this interview was within maybe 2 months of the actual bottom for the commodity, which was late 2016, right? And this thesis it just totally came in from 180 degrees of what I was used to in terms of the charts look absolutely disgusting. Nobody wants anything to do with this sector. Breakouts, I mean, you're looking at breakdowns. There's zero breakouts among the 50 companies in the space. But the commodity is trading at a third of what it needs to be for global average production costs. And there's reasons for that we can get into. It's still, at the time, and especially now, a vital industry, a growing sector. So it was this super, super contrarian investment where you're betting on a future outcome based on faith in the fundamentals, not having anything to do with the charts other than having a contrarian viewpoint. The worse the chart looks, the better. If you're actually betting on something of quality that you feel confident in playing out in the future. So that completely flipped how I had ever thought about an investment, and I started looking into it more deeply, and it's just kind of snowballed from there.
Okay, and so from there, in 2016, you're watching a podcast. The Uranium thesis is brought to you. How did you go into taking the action steps to get into that space specifically? It's not something, whenever you mention uranium in terms of investment, to the average person, they just don't get it. So how was that initial stage for you? What was it that really got your attention to say, okay, hang on a minute, this technical stuff is going well, but I'm looking at a potential opportunity, a potential generational opportunity based on the fundamentals of supply and demand? What was that initial 1 to 2 months worth of diving into the uranium thesis like for you?
Well, this story is not bandied about as much as it was when this was a pure contrarian investment. So right now we have a lot of momentum, both technically and fundamentally. More fundamentally than technically, it's been kind of a rough year for most markets, although we're about break even on the year, which I guess is a phenomenal win, all things considered. No, really, you heard stories about the previous bull market in uranium. That's really what caught my ear and what made the contrarian thesis potentially attractive, right? So, and everyone always talks about Rick Rule and Rick Rule's famous
Paladin and 1 cent
Paladin,
to $10. And
exactly. Yeah. But the cool I mean, the best part about that story is not that, it went from 1 penny to almost $10. The best part about his story is that he bought it at 10 cents and he sat on it. I mean, I could look at the chart right now. I think it went from 10 cents to 1 penny over the course of about 2 years. So he was sitting at 90%.
You can share your screen if you need to, man. I've given you permission. It's up to you.
Oh, cool. Yeah. Don't necessarily need it for this, but he sat on a 90% paper loss for 2 years, right? And then he had the conviction to buy more at 1 penny and 2 pennies.
Yeah.
And as he said, he sold way too early, but it still puts a smile on his face how much money he made in that trade. So I think about that all the time as an example of weathering volatility and how most people don't have that stomach. But the potential for returns from investing in a hated sector that has, at that point with $18 uranium, 10% of the global world's energy production and a sector set to grow, it was, nothing is guaranteed, but it's a practical guarantee that the price would go from 18 to 50 at least. And so the bet is equities would do 10x that,
And let's talk about that. So to break it down, we're talking about a commodity that has very inelastic demand, meaning you can't just go without it. And when you've got this commodity trading for less than the cost that it takes to dig this stuff out of the ground and get it to market, as Rick Rule says, one or two things is going to happen. The price is going to rise, or in this case, the lights are going to go out. And we need, as speculators, to work out which we think is more likely. So at the moment, where are we in terms of an all-in sustaining cost, would you say, for most producers? And then maybe talk about the developers, because we have experienced inflation and it's likely that we're going to experience higher inflation over the next decade. And I read Cameco's reports around cost inflation eating into their cost of production. Interested to get your thoughts on the AISC for most producers, and then maybe what an incentive price would be for some of these Namibian developers to get into production.
Sure. So currently uranium's at $50 a pound. That's spot price. That's actually the term price as well. The last reported term price, which is only it's reported every month, was $49 a pound. So right around $50 a pound is where the market's sitting. With that said, term contracts are signing for higher than that, but the reported term price is the best offer during that time period. So, and that's not even volume weighted, I don't believe. So if you've signed multiple millions of pounds at 65 and then somebody comes in and sells 100,000 pounds with 3-year delivery for 49, the price gets set
marked down. Gotcha.
Correct. Which is why in this market, I actually think that the spot price is going to drag up the term price. But just to kind of backtrack, looking at costs of production with most producers, the interesting thing is there's so very few producers currently right now. You have the 4 Mile plant or the 4 Mile mine in Australia, BHP's Olympic Dam in Australia. And that's very cheap because uranium is a byproduct of gold and copper production at Olympic Dam, BHP's mine. But the primary uranium producers right now are Kazatomprom and Cameco. You also have the Uzbeks producing. Their production is increasing and it's similar to Kazakhstan. So their costs are similar, possibly slightly higher. But for a fully allocated, so even beyond AISC, because you have to include things like the dividend that Kazatomprom pays into their actual costs. So fully allocated for Kazatomprom is probably somewhere in the mid 30s per pound.
Okay. Including
right now about 50.
And so if we're going on the company level, we're talking about like all the prior write-downs and non-cash expenses and that sort of stuff. Okay.
Yes, that's all in, including their dividend.
And so Kazatomprom would be the lowest cost producer in the world.
100% by far.
Okay. So the lowest cost producer at best can get this stuff to production for $30 per pound, best case scenario.
Yep.
And Kazatomprom sits in Kazakhstan. At the moment, we have a few geopolitical issues between Eastern Bloc, Western Bloc. What about this idea of who's the other player in the market? Tell us who the other big player in the market is in terms of producers and what they can dig up uranium for.
Well, the other big player is Cameco, and of course there's Orano. Orano doesn't get as much attention because they're private. It's a private company. But Orano, and they have JVs with Cameco in Saskatchewan, Canada, and JVs with Kazatomprom in Kazakhstan. So their mining is still coming from largely the same jurisdictions. They have a development project in Mongolia, but that's many, many years away from producing. So really what we're talking about is Kazatomprom and Cameco as far as publicly traded companies as the two primary producers. And you have the Chinese have some production, CGN, CNNC. CGN trades on the Hong Kong exchange, and there's production there in Namibia from the Chinese. But for the most part, that's higher production costs as well. So when we're talking about the lowest cost producers, we're looking at Kazakhstan primarily, Uzbekistan, BHP's Olympic Dam, because it's a byproduct, right, not because it's necessarily cheap to produce. And then Cameco in Saskatchewan. And Cameco is a little bit more difficult to get that fully allocated cost. They've had MacArthur River on care and maintenance for almost 4 years, and that was something like $10-ish million a month to keep on care and maintenance. So you have to bake all of these, substantial losses they had to take into the cost of production. So they're probably in the high 30s, if not low 40s, all in for Cameco's production at Cigar Lake and MacArthur River in Saskatchewan.
Got it. Okay. And so let's talk incentive prices. What sort of price would we need to see for these mines to come off care and maintenance? And then if we go even further out the development curve, if we talk the deep yellows of the world, the Bannermans, what sort of price would they need before they'd be comfortable enough to build the actual mines and get into production? What are your thoughts around that?
So MacArthur River is coming back online already, and Cameco is not a spot market seller. So the only reason they're bringing that mine back online is because they have sufficient long-term contracts at prices that make sense for them. There's a lot of mystery around the long-term contracts because they all have NDAs. That was my next question. And oftentimes you don't have access to the pricing mechanisms, how much of the contracts are fixed and how much of them are referenced to the market at the time of delivery. What we understand right now is the contracts that are being signed right now are majority, if not entirely, market referenced, oftentimes with floors and ceilings. Paladin's Langer Heinrich in Namibia is also coming back online. I see that you're drinking mate. My wife is from Argentina, so okay. I also drink mate.
It's in the morning here, guys.
That's right.
Wake up with the yerba mate.
Yeah. My wife drinks it all day long. She has like 5 mates throughout the day. So back to Paladin, Langer Heinrich is also is coming back online from care and maintenance. That's set to be producing in 2024. And Paladin's costs are definitely higher. There was also a lot of these PEAs and feasibility studies that have been done over the years past are so drastically different now, just in what's happened in the last 18 months, in terms of inflation and supply chain problems and labor shortages, et cetera. So Paladin, for example, they had a CapEx estimate 1 year ago of 87 million to restart Langer Heinrich.
Okay.
And they did an update on that CapEx estimate about 3 months ago, and it was up to 117 million. And that was over the course of about 9 months. Wow. So Paladin, 18 months ago would tell you they were looking for $55 to $60 a pound in term contracts. So that's probably higher now, but they do have some off takes with the Chinese that are going to pay market prices for that offtake. I think they own 20% of Langer Heinrich, if I recall correctly. So there's kind of a guaranteed income from part of their production. And I know that they've also signed some other contracts, likely at much higher prices as well.
Okay. And I do know that the term contract is notoriously obscure, but when we look at these term contracts, do we know normally what a typical term contract would be in terms of the length of the contract? What I'm getting at is, where are we in terms of the term contract cycle? If we knew, for instance, that a lot of the volume of the term contracts was going to be due for expiry and rollover in, let's say, 2024, which is something that I've read, I'm not sure if that's accurate. Can we then start to get an idea as to, okay, well, presumably, given all the things we've spoken about, we're going to have rising costs. So the next round of agreements for these term contracts are presumably going to need to be at a higher price for these producers to have any sort of margin. What's a typical term contract look like in terms of length?
So a typical term contract in terms of length is honestly, technically a term contract is anything beyond 2 years. I mean, the spot market is 12 months or less settlement. So a term contract is 2 years or more, but typically a midterm contract would be 2 to 3, 4 years, and long-term is typically starts 5. And the typical long-term contract will be 5 to 7 years. What we're hearing right now is that not only the length of the period of delivery for term contracts that are being signed right now is growing as opposed to years past, and as well as the volumes of the actual pounds signed under these contracts. So that's not only what's officially been signed this year, which is 106.5 million pounds, but that's also what's under discussion, is what we're hearing in terms of these term contracts that are being discussed and signed this year. More volume, longer period of delivery. If I could share my screen really quick,
Absolutely,
I can show you coverage for term contracts for utilities. Let me do that really quick.
I think.
All right, can you see that okay?
Here we are. Yes, indeed. This is the thing that really separates the uranium market from other commodities markets, where you just don't get the information as easily as you would like.
Yeah. It's a very, very complex and very opaque sector. And even with the commodity itself is very different. There's not really a just-in-time market for uranium. It's these term contracts is where the bulk of the material is bought and sold, and there's a whole complex fuel cycle of services. It's not just the uranium, but this chart comes from Yellowcake PLC. They're listed on the LSE. They hold physical uranium, and they put out a presentation, and this is on their investing presentation. So I wanted to give them a little credit for that, but this is updated each year. So you can see utility coverage for the US and the EU. And it's important to actually highlight the US and EU because the US and EU makes up the bulk of the quote unquote West as far as nuclear utilities are concerned. And Western utilities currently are not signing new contracts with Russia, which is the primary provider of enrichment and conversion. And we can go down that road in a minute, but This just kind of shows you their coverage. The EU typically is more covered than the US. Usually they'll have a minimum of 3 years of inventory, and that inventory exists across the fuel cycle. So they'll have some U3O8 held at a converter, some UF6 held at a converter, some EUP held at an enricher, and then they'll have fabricated fuel on site. And usually they'll have, and that's all part of this whole security of supplies, that is owning a bit of each element of the fuel cycle across the fuel cycle, as well as having at least one, if not two, core loads on hand at all times.
So and how many years worth would they want to have on hand? Would a utility need 2 years worth of fuel?
In the US, you typically will have a minimum of 2 years. Okay. And in the EU, you'll typically have a minimum of 3 years. And you can see the EU is better covered than the US. Mm-hmm. But you go out to 2025 and you have almost half of the US fleet, which is the largest fleet in the world, almost half of them uncovered in terms of term contracts. And that drops off in the EU as well, going out 2026, 2027 and beyond. So the bulk of the Western fleet, and I know this is also the case in some Eastern fleets. Now, China has a lot of inventory, but in the West, you see that there's massive term contracting that needs to happen going forward. And the big kind of linchpin with this is that in the years past, utilities have not had to come to the table to sign those term contracts because there's been such an abundance of above ground mobile inventory.
From the remains of the Soviet Union and then from Fukushima, all of a sudden the decommissioning of the Japanese fleet, is that where we had that excess above ground supply?
There was, yes, largely yes. So there was a huge demand shock from Fukushima that had to do with the Japanese shutting off all of their reactors over a number of months following the incident. So that was 10% of world demand that was gone overnight, basically. Germany shut down about half their plants in the next few years following Fukushima and then continue to phase out. They only have 3 left. And generally speaking, since then, nuclear has been growing. There actually is more nuclear energy being produced right now than there was pre-Fukushima. And that's with only 9-10 reactors being restarted in Japan of those 54. So China's been growing like crazy. And there's a number of other countries that have been growing as well. But yes, big oversupply, megatons to megawatts program that ended in 2013 from downblended uranium from old nuclear warheads. Then you had the Japanese demand come offline. Some Japanese inventory was sold into the market. At the same time, the Kazakhs, who were 100% state-owned at the time, until 2018, they were a state-owned entity, playing a huge currency arbitrage by a depreciating Kazakh tenge, producing in tenge and selling in US dollars, and they just ramped like crazy. I think they peaked in 2018. So their production continued to grow while demand shock just dropped by 10% overnight. Production came online. We had
It was the worst of all. It was the worst of all worlds in terms of demand falling off a cliff, creating new supply essentially. But now we appear to be on the other end of that seesaw with Japanese restarts, the fleet coming online. We've worked our way through that supply. Where are we in terms of the supply and demand at the moment? If you could give us a brief, like 10,000 feet view of global demand per year, how much that's expected to rise, and then our current level of supply and how much we've got left, and maybe how SPUT ties into sequestering some of that, which has really hastened the decline of supply recently.
Indeed. Currently this year, there will be about 175 million pounds of uranium equivalent consumed in the world's reactors. Might be slightly less than that due to France's problems they've had with their fleet. But somewhere in that ballpark, 170 to 175, let's say.
Okay.
And produced from primary mine supply will be about 135 million pounds this year. Okay. So it's about a 35 to 40 million pound shortfall.
Already. Okay.
And that's not including secondary demand at all, financial players, et cetera.
Okay, so that's the next question. In terms of SPUT coming into the market and the amount of pounds that they're able to take off on the supply side, and then on the demand side, I understand that with the Chinese building out their fleet, that will take some time before that really kicks into effect. But the Japanese restarting their fleets impacts us right now, correct?
Yeah, I mean, well, China has an ongoing build-out program. I mean, they've got more than 20 reactors under construction right now. They've had 5 reactor new construction starts this year, and they're looking at 6 to 8 per year going out to the end of the decade. So the China demand, and it looks to me that they are following through on their goals, their stated goals, and their stated goals are 70 gigawatts by 2025, and they're right at about 51 right now. And they want to have 200 gigawatts of nuclear by 2035. So we're talking 150 new reactors in the next 12 years. So they really need to ramp up to hit that. Will they hit that? I don't know, but it certainly looks like they're trying. We've also recently seen the Chinese in the market securing more uranium, securing more offtakes from Kazakhstan. They signed some contracts with Cameco recently, and they continue to come into the market for more uranium. So even though they have by far the world's largest inventory, because of their build out program, they're still seeking more supply from the world's producers. To go back to the supply demand situation. So the secondary demand, as far as the financial players, that's really an interesting point that you made, because the Sprott Physical Uranium Trust, also known as SPUT, they essentially have purchased 40 million pounds of uranium in the past 15 months. It's pretty significant. Their predecessor that they took over, Uranium Participation Corporation, had only purchased 18 million pounds in about a decade. So they purchased 40 million in the last 15 months. Of course, this vehicle is 100% driven by financial flows. And so with the markets being as they have this year, there's been very brief periods of time where they were trading at a significant premium to their net asset value, with a lot of volume trading, that they could raise a lot of money and buy uranium. So that happened, February, March, April was really the big time for them. The markets have been pretty risk off since then. So they've been a bit hamstrung, but this is one of those things that you can't model that. You can't model for what the financial flows are going to do. So you can look at this structurally, this market with a huge structural deficit between mine supply and actual demand. And then you say, okay, well, we're already sitting at 35, 40 million pounds. What happens if markets go risk on next year and SPUT buys another 10, 15, 20 million pounds? the market is so thin. It's so thin, so you can't model that out. But there's no guarantee that it happens. But if it does, it's going to cause a very rapid movement in the price.
Yeah, and talk to us about the flywheel effect that you've been well known for coming up with this idea of this spot price driving due to capital flows, driving up the spot price, which of course then makes the miners more valuable. So it drives up ETF flows. And so we've got the spot into the ETF and then into the individual holdings of that ETF. Perhaps give us a brief overview as to how that works, and then we'll move on to something different.
Sure. Yeah. I mean, what we call the flywheel effect is basically just kind of momentum begetting momentum, money flowing into the ETFs because they're the most liquid vehicles in the space. And because it's so small, there's only 70 publicly traded companies in the uranium space right now. And, 2/3 of them are held by the ETFs. So when big money flows in, they buy SPUT, they buy the ETFs, maybe they buy Cameco, Next Gen, maybe a little bit of Denison, but for the most part, they go for what's liquid. Really big players, liquidity is primary. They need liquidity more than they need even the investment case in some cases, right?
And we're talking about a tiny market cap for the entire industry,
tiny,
right?
Less than 40 billion.
Wow.
Yeah, tiny, absolutely tiny. So when money flows into the ETFs, obviously they buy their underlying holdings when the ETF itself has inflows greater than the inflows that are going into their holdings, right? And that happens on a day-to-day basis. So today we had really big volume coming into URNM. It was like 3 or 4x the 10-day volume, 10-day average. So the URNM probably issued shares and bought some underlying holdings today. And you can usually see it. You can kind of sense it when kind of everything is moving in lockstep, 3, 4, 5, 6% up on a day. It's usually ETF buying. But kind of that double flywheel effect is the fact that the Sprott Physical Uranium Trust is held by URNM as well. And so, kind of the thesis is that big money would position into the individual miners over time, accumulation. Some of these stocks looking like they're being accumulated over the past number of weeks, actually. And then they'd pile money into SPUT, and SPUT would buy physical uranium, and that moves the spot price. The spot price moves the equities, and it just kind of snowballs. But SPUT also is held by URNM. So as flows come into URNM, they buy SPUT.
Part of that,
SPUT issues trust units, SPUT buys uranium, the price goes up. So we've seen that happen a couple of times since SPUT's ATM went live last August. And, I think it's going to keep happening, obviously not consistently, but when it happens, it moves very, very quickly and very violently.
Yeah. You mentioned something interesting at the start of our discussion about the equities having a huge amount of leverage to the underlying commodity price. I believe you mentioned something like a 10x equity. Tell me a little bit about that. I'm used to looking at maybe metals miners or something like that, whereas your general heuristic or rule of thumb might be, okay, if you get a 1% rise in the underlying commodity, you might get a 3x on a fairly decent levered miner. Talk to me about this 10x idea, equity versus spot. You've got me very intrigued. Where does that come from, and what does that look like?
Well, that honestly, that really depends on what you buy. So that there's huge differences. So I'm looking at URA right now from the bottom of the commodity in late 2016. URA is up about 50%, and the commodity has tripled. So for the equities certainly have not played out in that manner. But there are some smaller caps that have done, let's see, I'm not going to bring up this name or show you, but this is one of our holdings. So we go back late 2016, and we've got, this thing is up 1,500%. And so, if you buy, and it's down 50% from the highs as well. So you saw a 30x for that particular stock, from the bottom of the commodity to the peak of the commodity.
For those interested in getting access to these names that have 30x leverage, you can join the Uranium Insider. Links will be in the description.
Yeah, that's kind of the idea, right? There's much more risk with the individual miners, but if you can find the needles in the haystack, or I guess the diamond in the rough, as it were, you can really outperform. So last year, URNM did about 74%, I think, for 2021, and we did about 125%. And that's with a diversified, 10 holding portfolio in uranium alone. So you can have leverage. We also like, I see you've got the options Bible on your bookshelf behind you.
Yes,
we
indeed.
also like to have some intelligently structured options trades that we have one of those on right now. But yes, I mean, typically in resource markets, the mining stocks will outperform the metal. And that's usually what happens. And I'll actually share my chart on this one if that's okay.
Absolutely, go for it.
Let's look at, if we look at this guy here. So this is URNM, or a basket of uranium miners, compared to
very
SPUT.
broad basket.
Yes, compared to SPUT, which is basically a proxy for the spot price. Now, yes, the SPUT trust does trade at a premium and discount to NAV at times. It's maybe 1% below NAV right now, so it's pretty close to the spot price. At this peak, we were about 20% premium to NAV. At this trough, let's see, was this October? No, it was July. It was 16, 17% discount to NAV. So this chart is a little bit exaggerated, but you can see the point. So this market really took off, in my opinion. The beginning of this bull market was in December of 2020. It's right back here. This breakout here. So you can see right now, we are barely above the lows when it comes to miners' valuations relative to the commodity itself. Wow. So there's plenty of upside still left in this, in my opinion. Now, the contrarian play obviously was to buy the washout in March 2020. And, my business partner is a former hedge fund manager, and his partner in his fund, they would always say, when you feel like puking, buy. And that's pretty much how it was in March 2020. And we've had a couple of those moments since then. This sector is extremely volatile. But as far as the miners' valuations, they're very, very cheap here compared to the commodity.
Interesting. And in terms of, so we're valuing the miners relative to the underlying commodity price which they produce. A true or false, the spot price this time around will drive the term market, or do you think it will be the other way around, given the fact that we've got those secondary financial players sequestering that supply from the spot market? Be interested to get your thoughts on that.
I would say true. And it's kind of in a backwards way, because the term market is the real market as far as the utilities.
That's where most of the volume is, right?
Yes, it's where all the volume is for the utilities. 95% of the volume, something in that ballpark. So, or maybe not quite that much, but most of it, yes, in the term market. But the interesting thing is that as these contracts are increasingly referenced to the market, you're going to see the spot price. Gosh, it's almost like the tail's wagging the dog is wagging the tail is wagging the dog.
Because the prices are set on the margin, and people are looking to the spot price, or the spot as a proxy of the spot price.
They're going to move up in conjunction, as they have already. And the term price has been mostly flat this year, as the spot has gone way up and then way back down. The spot went up to $64 a pound, came back down to 47, and now we're back up to 50. The spot price is going to keep moving up here, with or without spot. It's just too thin, and the utilities are there now. It's not only spot in the spot market. There's other players there. But yes, there's the traders really, to quote Grant Isaac from Cameco, the traders are the connective tissue between the two markets. So when you start to see markets go risk on and money is going into spot, you'll see the spot price move before spot even buys anything. Traders are going in there, they're buying uranium, and they might sell it back to spot, 1, 2, 3 weeks down the road, maybe months down the road. But they'll also be that connective tissue between the utilities actions in the term market, as well as everybody else's actions in the spot market. And the utilities do still buy a little bit in the spot market, but it's very, very small here, because their contracts are even legacy contracts that were signed 5 years ago that maybe they still have deliveries coming to them.
Okay.
Those are probably at least partially referenced to the spot price. So if you're a utility, you go into the spot market, you buy uranium, it kicks up the price. That affects your bottom line when you have to pay for that delivery on that term contract.
Right.
It's tricky, but yeah, I think the spot price is going to end up in the driver's seat with this market.
Okay. So it's interconnected like a spider's web. Let's talk about where you think ultimately the trajectory of this bull market might end up. Like let me hold your feet to the fire. So this thesis is not new, really. It's been around for a little while. Maybe 2018, a lot of people, or 2016, you got interested. 2018, a lot more people came into the party, including myself. But we saw a bit of a lag. Why now? Like, why are things different today versus, let's say, 12th of November 2018 or 2019? What's different? And how do you see this bull market playing out? How high can the spot price go?
Oh gosh, how much time do you have? Okay,
I've got all day. I don't know about you. I've got more mate ready to go. So I'm good to go.
Yeah, nice. Salute. Okay, so this thesis has really grown and changed in a relatively short time. So in 2016, even up to 2019, even into 2020, the thesis essentially was this is a vital sector. It's roughly 10% of the global electricity grid. It's growing 1 or 2% per year for this decade and beyond. The Chinese are going nuts. They're building a lot of reactors. The Japanese will probably eventually restart their reactors. And we've got a supply deficit. Now, there's a certain amount of above ground mobile inventory that will have to be worked through. In my opinion, that is basically worked through, judging by how thin the market is.
Okay, so that's a key point. So we're scraping the barrel of what we did have in terms of above ground supply. So that would be one reason as to why now.
Correct. Now, the spot market for U3O8 and UF6 converted uranium is not just like this static barrel of material that once it's gone, right? You have producers that sell into the spot market, but it's not a lot. It's a couple million pounds a month, maybe. So it's pretty insignificant with new production being sold into spot. So yes, a lot of mobile inventory got worked through. And that was the reasoning why, going back the last 10 years, term contracting volume really dropped off. Now, if we're talking about 170 million pounds a year being consumed, but only seeing 60 million pounds signed in term contracts, that's way below replacement rate contracting levels. Why? Inventories, mobile inventory that they've been able to buy in the spot market, buy these shorter term carry trades that are 2-3 year delivery, where a trader will actually buy in the spot market and fulfill deliveries for a utility. That happened like crazy.
There was no need to sign a term contract if you can just reach in and buy cheap pounds off the spot market.
Yeah. No need whatsoever. And, if you were going to sign a term contract, you'd sign one with Uranium One or Orano or Kazatomprom that had projects, production in Kazakhstan, going out to the middle of the last decade, totally state owned. And the production cost was extremely cheap. So you could sign term contracts at prices that were basically, at the spot price level in the 20s, very cheap. Right. So the thesis basically was vital sector, growth sector, China building a lot, structural deficit. Eventually the price will turn around, even in a market that continues in the way that it was, which was nuclear was very accepted in some places, very hated in other places. And you were just kind of betting on, because there's such a big sunk cost in these reactors, most of the time they will often get life extensions, considering if they are profitable, whatever jurisdiction they're operating in, right? So the demand, as to your point earlier, is pretty static. Even in recessions, you don't see a lot of reduced energy production coming from nuclear reactors because they're baseload. You can cycle gas and coal, even renewables up and down quite a bit. Nuclear doesn't cycle that much, so you can maybe cycle down 5 or 10% or something like that, but it's pretty static, right? So that was kind of the core thesis going back 2016 to 2020, right? COVID obviously was a big disruption to the mining operations. Cigar Lake shut down for 6 months. Kazatomprom stopped their wellfield development for about 6 months. But it didn't really change anything that much as far as the thesis until we started to see kind of the fallout, in my opinion, which was the fallout from government's reactions to COVID policies, which were lockdowns and insane money printing and huge disruptions to supply chains due to vaccine requirements, whatever it might be. All of these things affected supply chains and affected currency markets. And we're seeing massive inflation and broken supply chains, and all of these things have led to this energy crisis that's happening right now. And so, and there's another point I want to make too, but the energy crisis really is highlighting the benefits of nuclear. Nuclear obviously is baseload power. It produces zero carbon emissions during its operation. And it's a very, very long-lived asset. You can store decades of fuel in a warehouse. So it's very, very secure in terms of energy security, national security. And the
Which is
energy
extremely
crisis,
topical.
yes, 100%. So what we've seen with huge increases in costs for natural gas, oil and coal, they've come down a bit since the peak, but that's been a massive cost increase for governments and for civilians in terms of keeping the lights on and keeping the factories running, and it's really put a fine point on the benefits of nuclear, and that has caused a lot of countries to not only place a higher value on their existing plants, but to recommit to building new nuclear. And the United States is one good example of that. The recently passed Inflation Reduction Act earmarked, I believe, off the top of my head, 350 billion, something like that, for nuclear. And so a lot of that is in clean energy tax credits. Basically, what it did is it guaranteed the profitability of all of the existing reactors in the States. So not only were we seeing, even in California, which is very, very left-leaning, which is historically anti-nuclear, extended the life of their last reactor. We saw a plant that was shut down earlier this year. They're thinking about bringing that back online in the state of Illinois. And then there's big government support of advanced nuclear and new builds. So the energy crisis has really supported nuclear. And that is on top of another thing that has played out, sorry for the long answer, over the past few years, which is the increasingly panicked concern by governments about climate change and net zero goals and things like that. So we've actually seen kind of the environmental left sort of come around to embracing nuclear as a clear solution for that. And this is, I mean, gosh, I don't want to talk too long. This is all on top of something that's not really being discussed, but is really top of mind for me, is that I honestly think a lot of the climate change carbon myopia has actually to do with a recognition by the powers that be that fossil fuels are limited. We don't really hear talk about peak oil anymore. I don't know why that is, because the shale revolution just completely silenced that topic, perhaps. But oil is finite, and whether or not we're talking about peak oil, we're definitely talking about peak cheap oil.
Absolutely.
And so you have something called energy return on investment, which is how much you get for what you put in. And in order to maintain society as we are now, it's somewhere between an 8 and 10 return on investment for energy. Solar gives you about 6 or 7. Wind gives you about 15. Oil gives you about 20. Natural gas a bit more. Nuclear gives you 100 units of energy return on investment. And so if we're talking about peak cheap oil going out into the future, in my opinion, we're looking at multiple decades if governments come around to logic and math and what is best for society. Then nuclear has an incredible growth story behind it.
I think you nailed it. My largest investment position is in the oil space. Shubham Garg from White Tundra Investments and I spoke about this for 2 hours on a podcast, talking about how the shale party is over. Peak cheap oil definitely is over. And all the things that you mentioned, the political winds changing, the geopolitical deglobalization, the inflation through supply chains, the demand rekindling, the supply destruction, they're all the key factors. But I think you absolutely nailed the inflection point, which is peak cheap oil. That's the thing that we've relied on. And in order to get something that's base load with an acceptable energy return on energy investment that is also adequate from the policymakers' point of view of being net zero, there really is only nuclear power. I can't think of anything else that fits the description. So yeah, I think you nailed it. I think no one else has actually put the finger on what it really is, on what the perhaps the most pertinent point is. It's peak cheap oil. And we've seen people in Germany reverting back to like lignite coal and all this stuff because they couldn't get the gas. And and I think that instead, moving into the future, we're going to learn from that and invest in nuclear. So
I
that's
agree with you. Yeah.
yeah, that's super important. If we can we touch a little bit on this Cameco Westinghouse deal? I'm trying to work it
Sure.
out.
Yeah.
Is it a net positive? Is it a net negative? Is it going to be good? Is it going to be a disaster for Cameco? I'd be very interested to get your thoughts on that, and then we can move on into the ROI segment, perhaps.
Cameco sees where the wind is blowing. I mean, they make very long-term decisions for their company. They obviously have invested. I mean, the mines that they're operating in Saskatchewan are so unbelievably complex. I mean, there's very high grade mines that they are only operating because they were able to install and implement what's called a freeze wall. They're basically freezing the edges of this mine shaft to keep an aquifer from flooding into the mine shaft. I mean, they believe in the sector. They believe in the growth of nuclear, and they believe in the vital importance of uranium. And this acquisition, in my opinion, was a big planting of their flag on the future of nuclear. And they definitely believe they know where it's going. And I mean, who knows? They are very likely probably thinking along the same lines as URI and what we were just talking about, seeing where it's going. Now, Westinghouse is probably the biggest player in the world in terms of nuclear buildouts and manufacturing of nuclear of elements for nuclear plants, as well as fabricated fuel for nuclear plants. They have 9,000 employees. Having skilled workforce in this sector is very, very difficult to come by. So 9,000 skilled employees is hugely, hugely valuable. A big, interesting piece of market share that they're stepping into for the company is Eastern Europe. Now, Eastern Europe has 34 Russian-designed VVER nuclear reactors. These are reactors that have a particularly unique shape of fuel rod that up until not that long ago, only the Russians were making. Now, Westinghouse makes that fuel rod as well. And most of these Eastern European utilities that are operating these Russian-designed VVERs are looking away from Russia for that fuel. Not only for that fuel, but for all elements of the fuel cycle as well. So this is a big market. This is 15 million pounds of uranium for these reactors. So yeah.
So they're looking at being a fully vertically integrated player where from pounds all the way through to watts is what they're selling, essentially, like a full solution of getting the fuel from the ground, controlling these reactors, and then selling power to the grid. Is that how it's going to work, or how they see it's going to work?
Well, Westinghouse, to my knowledge, doesn't actually operate the reactors and sell the electricity. But what they do is they build reactors. So right now, even the Chinese just signed a recent contract to build an AP1000, a Westinghouse design in China. They just signed a deal with Poland. They're going to be building 6 AP1000s in Poland. Westinghouse will be. But Cameco with Westinghouse will basically have exposure to the entire fuel cycle, with one exception, but that is going to change, which is enrichment. So Cameco has obviously U3O8 mining. They've got processing at Blind River. They've got conversion at Port Hope, and now with Westinghouse, potentially also at Springfields in UK, an idled conversion plant. Wow. For enrichment, they have a share of GLE, Global Laser Enrichment, which is majority owned by Silex. Cameco is more than likely going to take out their majority share, and I think they can increase up to 70% ownership, which they probably will. That's a little bit later on in the decade and still somewhat speculative at this point. But then they have fuel fabrication. So besides enrichment, they have everything across the entire fuel cycle now with that Westinghouse acquisition that they can offer to utilities.
Okay, that's super interesting, considering that we're seeing this east versus west decoupling. They're essentially going to bridge that gap in such a way that they are going to control the intellectual capital from go to woe, and potentially have a monopoly over the reactors in terms of those fuel rods that you mentioned. Does that mean that they will essentially be kind of like Apple, and that you can only have a certain charger for your iPhone? You can't just use any Android charger. Is that the way they're going to play it, so that they have control from start to finish, and they can really dictate the flows of fuel, and obviously then they will sell fuel to their reactors from fuel sources that they also own in that integrated system?
Not necessarily. The sometimes, and this was especially the case with the Russians, because as a nuclear utility, you could call up the Russians and say, we need uranium conversion, enrichment, and fuel. And, with one phone call, you can knock them all out. But with that said, oftentimes these services are not necessarily bundled. So utility might go secure uranium from Paladin in 2027. They might secure conversion from Orano in 2028. They might secure enrichment from Urenco in 2029, and fuel fabrication from Westinghouse in 2030, and delivery in 2031, right? So yeah.
Cameco wants to combine that or integrate that as best they can.
Well, I think that would be good for the company, because if they're talking to one of these, especially with the Eastern European VVERs, because these reactors were totally 90% buying from Russia, everything, uranium conversion, enrichment, and the fuel fabrication that the Russians primarily provided. Westinghouse has been able to make these for a while, but the Russians did it cheaper and faster, right? So now if you're operating one of these reactors in Ukraine, you're not going to Russia to buy the material. So if you need the fuel rods in 2028, you're going to call up Cameco or Westinghouse, and Westinghouse is going to say, cool, how about we bundle this with some uranium and some conversion? Yeah. I mean, it makes sense for their business. So I think that potential is definitely there for the company.
Yeah, that's huge. In terms of the bottleneck, enrichment at the moment seems to be the main bottleneck. Is it true to say something like 60% of the enriched uranium is sourced from Russia?
About 40%.
About 40%. Okay.
They're the largest player.
Okay. So who at the moment, if anyone in the West, is looking at taking on that responsibility to solve this problem of enrichment security, as in supply security of enriched uranium?
Right. So this is another element to the thesis that has been added since that original thesis, right? We were just talking about like the 2016 to 2020 thesis. Well, this is new as well, and this is new this year, and that's a bifurcation of the market. So now essentially we have Western nuclear utilities, which is about 70% of total global nuclear energy generation comes from the quote unquote West, let's say the OECD countries,
okay,
versus the BRICS countries. There's some overlap between the two in terms of how the nuclear utilities act, but just as rough numbers to go off of. So you've got 70% of nuclear utilities in the West and a minority share of the conversion and the enrichment markets.
Okay.
So the big thing with Russia was and is conversion and enrichment. So about 40% of enrichment, about 37% of conversion. Conversion is the tightest point in the fuel cycle right now. That's going to be somewhat alleviated in the next year or two. Calverdine's Metropolis plant, which was idled in 2018 in Illinois in the United States, that's coming back online next year and has the ability to increase capacity. Orano is talking about increasing their conversion capacity as well. Enrichment, the big thing with enrichment is that while conversion, you can't really alter the inputs and the math of that process, let's say, to synthetically increase the conversion capacity. Conversion capacity kind of is what it is, which is why it's the tightest element in the fuel cycle. But enrichment, what the enrichers can do and what they are doing is they are, so the way that uranium is enriched is it's first converted into a gas, into uranium hexafluoride. That's the conversion process. And that is done so that it can be enriched with the current methods that we use for enrichment, which is a gas centrifuge. And this centrifuge spins this gas at very high speeds, separates the isotopes. The fissile isotope is the minority isotope. It's only 0.7% of the natural uranium, the UF6. And they have to spin that up from 0.7 to about 0.45, 0.46 enriched uranium to go into fuel fabrication, into the reactors. And so the way that the enrichers dictate not only the cost of the enrichment process, which is SWU, separative work unit, that's the cost of enrichment, but also the amount of feedstock that they need in UF6 to produce X amount of enriched uranium at X level of enrichment. The way that they calculate all of that is based on supply and demand and capacity. And that is through what's called a tails assay. So that is the percentage of the U-235, the fissile uranium isotope, the percentage of U-235 that's left over in the tails, or the waste. It's not waste, but let's just call it waste, after enrichment. So if you're spinning these centrifuges down to a tails assay of 0.17, you're spinning that material a lot more for longer. You're squeezing more out of it than you would at 0.2 or 0.25, right? So the more of the U-235 you have in the tails, the less enrichment that you're doing, and the more material you need on the front end.
Because it's a faster throughput, right?
Yes, exactly. And you can get a faster throughput by raising those tails assays. And that's what essentially they're having to do now, because the demand for Western enrichment has just gone through the roof by Western utilities who don't want to sign any new contracts with Russia. So the reason that's important is because a jump from a tails assay of 0.18 or 0.2 to 0.25, which is what they're operating at now, is a 15% increase in demand for the feedstock. And the feedstock is uranium, is UF6, but you can't synthetically expand. You can't produce more converted uranium with the same amount of mined uranium. So more UF6 feedstock equals more U3O8 mined uranium at the beginning of that process. Correct.
Okay.
So this swing that we're talking about now between 135 million pounds of mined uranium, 175 million pounds of demand, let's call it 40 million pounds. There was something called secondary supply from enrichers, and that still exists. Although right now, so the primary source of secondary supply from enrichers came from something called underfeeding. So if you were an enricher and you had excess capacity because you had reduced demand, and this was the case for a good part of the previous decade, you had reduced demand because you had downblended material until 2013. You had an oversupply from Kazakhstan of mined uranium. Utilities contracted like crazy during the previous cycle, so demand for enrichment went down. You had excess demand, so what you could do is you could sign a contract with the utility, and they would need X amount of KGU of enriched uranium at 4.6, whatever it might be, enrichment, and you'll sign that contract at 0.21 tails, for example. Then that kicks out.
You were not under pressure to put that uranium through, so you could take your time and squeeze as much as you could out, hence the low tails and high enrichment, right?
You had more enrichment capacity than you did demand from the utilities. So not necessarily more time, but more total centrifuges to utilize for that process.
Okay.
And so if you sign a contract at 4.6 for X amount of EUP at 0.21 tails, that kicks out a number of how much UF6 the utility has to provide to you as the enricher. So if they send you this amount of UF6 at a 0.21 tails assay contract, and you've got all this excess capacity, you could spin that stuff down to 0.17, keep the extra feedstock, sell that into the spot market. You literally underfeed the centrifuges. So this element of the fuel cycle, really underfeeding, was about 25 million pounds a year of secondary supply.
And that's a lot.
It's the biggest uranium mine on the planet, basically. Wow. Is the underfeeding from enrichers. So when you consider that the capacity of enrichment in the Western enrichers, let's say, is about 40% of total enrichment capacity in the West. Okay, a little bit. No, excuse me. Hold on. 40% is coming from Russia. Either way, that 25 million pounds. No, I believe it is close to 40% between Urenco and Orano. Okay, so that amount of enrichment underfeeding is gone. So that's 10 million pounds, 40% of 25 million pounds.
That is no longer available.
No longer available. And that's gone now. That's not theoretical. That's not next year. That's basically gone right now. That's secondary supply. Big deal. So now we've got a 50 million pound swing. It's very, very large. So you've got 50 million pound swing based on, and this is just a snapshot of this year, right? MacArthur's on next year. it helps out a little bit, but
Sure, but that's going to
huge.
take, like, how long is that going to be? How long would that take to be able to get close to
MacArthur
equilibrating?
River,
Yeah.
they expect to be full production 2024.
Okay. And how many pounds can they likely get to the market?
They're shooting for, I believe it's 15 million pounds, but they're also dropping Cigar Lake down to 13 and a half. So that's coming down from 18. So it's about a 12 million pounds, let's say, increased production in 2024. Yeah.
So we are expected to reduce this current deficit of, let's call it 40 to 30-ish.
Well, but what I'm talking about here with this bifurcated market and the underfeeding to overfeeding situation is not only is 10 million pounds of secondary supply coming from Western enrichers not going to be there, but the increase in the tails assays is a 15% increase in Western demand.
I see.
So we're talking about a 30 to 40 million pound swing just from this bifurcated market and the enrichment market shifting.
Okay. And so when you net out the expected increase of Cameco's production, where does that leave us in terms of a supply demand deficit?
Well, that also depends on some other players and what their production is going to be. So that's
Okay,
BHP
sure.
and the Uzbeks and everything. The market gets a little bit closer to balance, but with this swing with the bifurcated market, we still end up with roughly a 30 to 40 million pound deficit, even with MacArthur back online because of this swing due to the enrichment that I just explained. Yeah.
Okay. And assuming no further sort of crazy supply disruptions or anything like that.
Correct.
Okay.
Now, eventually the enrichers in the West, if the market stays bifurcated, if that is to say that if the Western utilities do continue to not buy from Russia going forward, if that remains, eventually the Western enrichers will expand capacity, but that takes years and billions of dollars of capital. So this situation won't necessarily persist forever, but it's going to persist for probably 3 to 5+ years.
Wow. That's hugely interesting. Before we move on to the ROI segment, I've got to circle back in terms of getting a trajectory. So we spoke a little bit about the previous bull cycle, and correct me if I'm wrong, but spot prices peaked at around 140 US dollars per pound. Do you see this bull cycle as being analogous to the previous one? And if we take into account all the disruptions, all the inflation, where are you gut feel? Where do you think the spot price could end up by the time this is all said and done over the next, who knows, 7-10 years?
I really don't have a gut feeling on this.
Come on, Justin. I know
I
you
don't.
do.
I mean, I can tell you, I think it's a practical guarantee we're going above 100. And I think anything beyond that is dictated by things that are beyond market forces in the short term, in the short to the midterm. I mean, if we're talking about an absolute nuclear renaissance, the International Energy Agency, the IEA, does an annual report called the World Energy Outlook. What they propose based on hitting their ideal net zero targets is 5,400 terawatt hours of nuclear by 2040. That's more than a doubling of the current world's fleet by 2040. And this is coming from the IEA. This is not coming from a uranium miner. This is not coming from an investing shill. This is coming from the IEA saying we need to more than double nuclear in the next 17 years. Okay.
Is that above or below their annual revision for oil demand? Because miraculously, oil demand is always underestimated by the IEA.
I don't know. I mean, I really don't know how this is going to play out. All I know is like something has to happen, and it makes sense to me that nuclear shines and takes a lead role. But so if we're talking about that scenario and we see the growth in nuclear significantly increase this decade, then market forces will bring it beyond that $100 a pound range, right? But at $100 a pound, most projects in the world, if that price is sustained and the capital markets are sufficient, then most projects in the world can get funded and can come online and have at least a small profit margin. Even the Deep Yellows and the Bannermans, with the Namibian lower grade mines with big capex to get into development, at $85 to $100 a pound, those projects are profitable if they have contracts, right? They're not going to develop. Bannerman's not going to develop Etango without a significant offtake or contracts in hand that will guarantee they'll be able to sell at those prices before they raise, hundreds of millions in capital.
Yeah, exactly. And
Yeah.
if the Chinese want to buy it out at a massive premium as a shareholder, I'm okay with that. But anyway, that's another story. Yeah,
So
so that
let me
seems
give you a
reasonable.
better answer.
Okay,
Let me give you
okay.
a better answer. I think $100 a pound is pretty much baked in within a 2 to 3 year time frame, with zero demand from secondary demand from financial players. If SPUT, let's just say capital markets suck and SPUT does not trade at a premium to NAV for a single day in the next 3 years, I think we're still going above $100 a pound
Based
over that time frame.
on those comfortable fundamentals that you mentioned.
Totally.
And then on the other hand, if we get a risk on environment, or if we see a decoupling from the uranium market versus the rest of the broad equities, which might really suck because they're way overvalued, then you just may see that situation more sentiment driven, where price rise begets more price rise, begets more price rise. And then we could potentially have an outside right tail risk of.
I mean, you can inflation adjust from 2007, $134 a pound to right now. That's $200 a pound. You can do that if you want. I mean, but yeah, the sky's the limit for the financial players. Truly.
Yeah, that's super interesting.
I can't predict it. I can't model it. I mean, there's going to be some secondary demand, but how do you model that in a supply and demand spreadsheet? You don't. You conservatively don't. And whatever comes is gravy on the thesis. But yeah, no spot buying whatsoever. We're going above $100 a pound,
which is a double from current spot prices.
Correct.
So I like that asymmetry personally. All right, guys, it's ROI time, and this is where I get to ask Justin about his best returns on investment. I would love to know. So, what is your highest ROI from any investment to date? If you can give us a backstory and perhaps some numbers as to how that came about, I'm sure that I'm not the only one who would be fascinated to hear.
Let's see. My highest ROI is a position I'm still holding. It's in the uranium space. And I'm up about 2,000% on that. And I consider that it's going much, much higher. So what is that? That's a 20x. But I haven't sold it, so I haven't realized that gain yet.
Okay.
But that's been my best one so far. I think this particular position could still 5x from here. Okay. So it could be 100 bagger.
Okay. And is that particular position potential 100 bagger available to Uranium Insiders?
Indeed. Yeah.
Excellent.
I think it's particularly cheap right now, actually. Interestingly enough, this particular stock that I have these embedded gains on, I actually bought more today of this stock. So yeah.
I can hear Lobo Tigre is in the back of my mind crying, saying, take some profits, upside maximizer. But I guess that's the thing, right? I mean, in the 100 bagger book that I have behind, it's conviction and buying right and holding tight over those cycles.
Yeah. I also hate to create tax events. So I tend to trade in and out more on positions that I have less conviction of. I had a multi-bagger in natural gas that what is it? I bought Ontario Resources at like $1.20.
Oh my goodness, good call.
$37 right now, but I sold it way early because I didn't know the sector. I didn't know the fundamentals well enough to hang on. That thing's going much higher too, I think. Okay. And I can't chase. I can't chase. I psychologically can't do it. I've had some big wins with options trades too. I've had a lot of 5 to 10 baggers in the options markets.
Okay. Yeah. Through bull calls and calls.
I love vertical bull calls. Yes.
Calls.
Yeah.
Very, very
call
nice.
Spreads. I love call spreads. Yeah.
I love it. And in terms of your setup, I have a friend of mine, Fergus Cullen, who's been on the channel. He is the king of the bull call when something's been smashed down. How far out of the money do you like to go? Do you like to go first leg close to the money and then give yourself plenty of room to run?
It depends on what it is and what my conviction is. I mean, if I'm doing vertical call spreads in the uranium market, I'll either go shorter term and go kind of in the money and look for 2 or 3 baggers, or I'll go, let's see, I'll go like right now, I'd probably be looking at 2024 and I'd go probably 25, 30% out of the money. I think my most aggressive, let's see, I just did Here, I'll tell you one verbatim, just not in the uranium space, that I entered about 2 months ago, which was Transocean. So the ticker is RIG. I entered that. It was about $3. I bought January 2024 4-5 call spread for 10 cents. And now it's almost
Very nice. Yeah,
it's almost in the money. That's actually the long call is in the money.
it will be.
That was a good one, but I got to hold it for another year to max out that trade. So I was a little bit too conservative on the timing on that one, but it should still pay out pretty significantly. Even if I sell it early, that's a 5-bagger.
Yeah, I think I also own some options on Transocean, so I think it's got enormous torque to the upside. Okay, and broadly, we won't give away the specifics. If you want the specifics, guys, you can sign up to the Uranium Insider newsletter. If I ask you very generally, where do you expect most of the alpha to come from in terms of this uranium bull thesis? Are you expecting the spot market, the producers, developers, or explorers? General thoughts on where you would allocate your weightings as of today, as things currently stand in the market.
So our process for determining positioning within the sector looks at a lot of different elements, but the companies that ultimately we really like to own are companies that either are real companies right now or will be during this market. By real companies, I mean they'll produce something. They'll produce some kind of cash flow. We especially like companies that fit that bill and also have potential individual company catalysts during that market. So we're less attracted necessarily to, unless the deposit justifies so, to a company with a big land package that's exploring. We're not really looking at drill plays. Typically in a resource bull market, a small cap explorer that can hit a new discovery during a bull market can have unbelievable gains. I kind of don't think that's going to happen. I kind of don't think that's going to happen in this market because there's only a couple dozen of these companies and they've been drilling for the last 5 years. I don't think there's going to be any big surprises on the exploration front in the uranium space. That's just kind of my gut feeling. I could be wrong. Maybe one company is going to hit something that shocks the market, but I kind of doubt it. I think the real crazy high grade stuff has sort of been found. And again, I could be wrong there, but so we like companies that are going to be producing actual cash flow, actual uranium during this bull market. And that's the bulk of our positioning.
Okay, so you're confident in most of these, or I won't say most of them. How confident are you in a large amount of these developers getting into production? Because it's no mean feat, right? To take a development project into production takes a lot. How many of these developers do you expect to get into production by the time this is all said and done? Because I mean, during last bull
market,
not very
many.
Yeah, last bull market, I think, was it only Paladin that got to production?
Paladin was the only one that took a project from exploration development into production during that, but the bull market happened so quickly. There were a lot of companies that were close, but just, the price didn't stay high enough for long enough for them to.
And that abrupt end, I suppose, really ended the dreams of many developers.
Indeed. Yeah. So not many. There's going to be a few. But yeah, not too many.
Okay, fantastic. Well, I don't know about you. I've massively enjoyed this conversation. I would love to wrap it up with you, and perhaps telling us a little bit about the Uranium Insider publication, who it's for, and what sort of material is covered, and some of the options that people have in terms of subscribing.
I think that our service is best for someone who has already some level of at least mild conviction or interest in the uranium market. We don't really like to convince people to put their money into the space. If someone already has that mild conviction or interest and or a reasonable amount of money invested in the space, I think that our service is an absolute necessity. We look at everything that's going on in these markets and we distill it down into what is actionable and what is important to understand as an investor in the uranium space. I think one of the most impactful things that we do, and especially over this year, is break down the fundamentals and express those in terms of conviction that we have for the sector and helping people off the ledge, let's say. keeping people in the game, not selling at the lows. I think that that's very, very psychologically difficult with this particular market and any sort of resource market or volatile sector, crypto, oil and gas, whatever it might be, right? It's very volatile and you have to have conviction to stay in. Unless you're trading the charts. If you're trading the charts, trade the charts. But this sector, what tends to happen in this sector is some catalyst will come in from left field that's mostly or entirely unseen, and the sector will move 20% in a day. And then you're chasing, and that sucks. And so we like to treat this in a contrarian manner. We have a long-term vision for the sector. We think that depending on flows, this could be a 2, 3, 4-year investment. It could be a multi-decade super cycle for commodities based on the reasons we talked about today. So what we provide is a very in-depth monthly newsletter, 30 to 40 pages, mostly focused on macro, but of course we discuss our positions. We have what's called a focus list. Right now it's 11 positions. It's 10 companies and an options position. We provide a monthly webinar, and this webinar, I think, honestly, could be the most valuable thing that we do. We typically have either a CEO or a member of management of a company that we hold, or someone who represents some facet of the nuclear fuel cycle or the nuclear industry. So we've had John Chapaglia from Sprott. We've had Grant Isaac from Cameco. We had a fuel buyer, Jeff Garinger, a former fuel buyer named Jeff Garinger, on our podcast last month. This month, we're going to have a managing partner, a portfolio manager for one of the big hedge funds that is focused on uranium. We're going to be speaking with him on Monday in our webinar. So these members-only webinars, we go 2 hours, super in depth.
Yeah, so worth the subscription alone in terms of the insight that you're able to get.
100%. Yeah. And then on top of that, we have obviously our recommended positions and as needed trade alerts, email bulletins that will go out in real time based on trade alerts. But we generally speaking focus a lot on the macro and focus on the overall thesis and taking all of these complicated things, a lot of which we've talked about today, and distilling that down into a concise message that can be actionable for investors.
Excellent. So someone who gets it, they listen to the podcast today or other discussions that you featured in, they understand the basics of the thesis, and they make their decision that they want to get an edge in the space. They are the type of person that will benefit from this subscription service because, as we mentioned, one of the main ETFs, EROI, has not quite kept up in terms of spot price performance, but if you don't mind, and disclaimer, guys, this is not advice or solicitation, but are you able to talk about the performance of those 11 positions?
Sure. Yeah. So last year, our performance in the portfolio was 127%.
Okay. Which far outperforms the ETF. So if
URNM was the best performing ETF last year, and it did, I think it was 73-74%. So we outperformed URNM by about 60%. This year, we're kind of neck and neck with URNM with our portfolio. We have some of these positions, like the options positions, for example, is pretty leveraged. So when the markets go risk off, some of the more leveraged plays can underperform. But when the markets turn up, that outperformance really shines. So hopefully we'll end up. And right now, let's see, we are roughly in line with URNM. I think we're down about somewhere between 5 and 10% on the year, which, honestly, all things considered, is not too bad, considering that there's been what, $45 trillion in wealth wiped out this year in the markets. It's been a bloodbath. So knock on wood, things keep looking positive for us here. Yeah.
So there you have it, guys. You have the qualitative and the quantitative explanation as to the benefits of the Uranium Insider service. Comes highly recommended from myself. Mate, thank you so much for that. I would love to catch up with you in a couple of months and see how this thesis is playing out. In the meantime, is there anything I missed, or is there anything that you would like to add before we wrap it up?
I don't think so. I think that just, I guess the last thing I would say is that markets are volatile. Markets have been very choppy this year. Choppy would probably be a generous way to describe them. But focusing on the actual fuel cycle is something that we really put a lot of energy into, and uranium's going higher. I mean, I can say that with 100% pure conviction. So the markets are going to do what the market's going to do. We are outperforming the S&P pretty significantly. And I think that that's going to be a continuation and a theme going forward for commodities in general, as well as uranium specifically. So focusing on the fuel cycle, we know where this is going. Markets are going to do what they're going to do, but we trusting the fundamentals, trusting the fuel cycle direction, we believe that the equities will follow suit.
So there's no substitute for conviction. So we want to skate to where the puck is going, and we're going to get an idea as to where that puck is going to be by watching the fuel cycle.
Agreed. Yep.
I like it. And if you want to know what the fuel cycle is doing, you got to sign up to Uranium Insider, guys. Justin, thank you so much for that. I really appreciate it. I look forward to catching up with you down the track. Thank you for listening, guys. Make sure you subscribe to the ROI channel for more great podcasts. And I look forward to catching up with you in another episode. Until then, take care, everybody. Bye.